Hi, thank you all for attending today's Level Up Academy with Good Business Colorado. Today's session is the Fall Employee Benefits Savings and Family FAMLI/PFMLI update with Miss Stacy Gilbert and AJ Newbaum.
So I'm Stacy Gilbert with Denver Tech Insurance. I've been in the business of employee benefits over 25 years, the Fortune 200 level. I'm going to present on how to save on coverage this fall and for first quarter of 2024. But because we are time pressed for one of our speakers, we're going to have AJ speak first. AJ is my rep from the principal, and he's going to talk about Colorado family and medical leave insurance through the state. And he'll also talk briefly on private options without getting into any insurance carrier. And then once he is done with his presentation, I will be speaking about the fall benefits update that's going on with the carriers. So AJ, it's all yours.
Thanks, Stacy, and thanks to everyone who's able to watch this. I'm really appreciative of the opportunity to be here and excited to be part of Level Up Academy with Good Business Colorado. As Stacy said, my name is AJ Newbaum. I'm a local sales rep with Principal and have been in the weeds of this legislation since I learned of its inception last year. But we're actually going to cover a lot more than just the product itself. And that's because this is a lot of unknowns for us Colorado employers, but this isn't the first state to roll out a paid family and medical leave product. And as you heard before we even started, there's a lot of terminology people are using for this product and legislation. Prop 118, Colorado Family, Colorado Paid Family Medical Leave, PFML, they're all one and the same. The state has named this product Family, FAMLI, while us insurance carriers refer to it as a paid family and medical leave insurance product, abbreviated to PFML. So if you hear me say family in one breath, PFML in the next, paid family medical leave in the following, just know we're still talking about the right product and we're still talking, you're on the right call. Before we get into the Colorado specifics, I wanted to provide a timeline, first nationally and then more specific to Colorado. We'll talk a little bit about what this product is, true of the state, definitions, eligibility, the leave types that your employees will have at their disposal, and more. And then about halfway through, we'll pivot over to what the private sector is providing. I'll draw on some specifics to Principal. I'll commend those to the insurance industry in general. But a lot of what we're here to talk about today is the options you have at your disposal. So at the very least, I hope you all leave this educated and understanding what you do have the authority to do by working with Stacy to make sure you're paying the most affordable price and getting the best service possible. The actual first statutory legislation that we needed to be keeping in mind was in California back in 2004. And that wasn't a paid family medical leave product, but that was a statutory compliance. And as much of this product as it is an ancillary product, it is compliance. We do all have to follow the rules, and we're all in the same position here for the most part. So I say New Jersey in 2009, Rhode Island 2014, simply to share that states have been getting involved in the insurance industry for some time now. And then we get to 2021 with Massachusetts, who was the first state to roll out this same type of PFML product. So we do have about 3 or 4 years of data we can pull from to make us that much more credible here in Colorado. But as you're seeing, the timeline doesn't stop with us. There are other states rolling this out. There are actually a few that have passed recently. So this isn't going away anytime soon. And if your business have any plans of expanding to different states, compliance is always something you should be keeping in mind. The next slide, you'll see more specific to Colorado. This did get approved back in 2020. And I don't know about you, but to me, that feels like a lifetime ago. But we do land on January 1st, where every company was defaulted into the state's fund. And that is done automatically with the benefits actually becoming eligible to be used starting in January 1st, 2024. We'll talk a little bit more about why there's a year gap there between when payroll contributions began and when benefits started. But this is the timeline we're all paying attention to here in Colorado. The first thing about this product is the eligibility is unique comparatively to your medical or your dental or vision or life or disability benefits. Those are typically geared towards full-time employees, looking at an hours of eligibility based on how many hours an employee is working per week. Standardly, that number sits around 30. But it can be flexible if you want to cover those borderline part-time, full-time members, and there's always unique situations. But what's different with this PFML product is that it doesn't look at the hours that an employee works. Rather, it'll look at the income that an employee is receiving. And that doesn't have to be specific to your employer. You'll see on the left-hand side there are 3 bullets saying if any employee makes $2,500 in the base period, you'll have to cover them. And the base period is essentially the last year. So $2,500 is a very low threshold to cross. And while there are no blanket rules in insurance, I'm viewing this essentially as all of your part-time and seasonal employees would have to be covered for this product, where they probably are not covered for your other employee benefit offerings. You'll also see the income doesn't have to be from you, their current employer. If they made it within Colorado from their previous employers, you'll still have to cover them day one. Remember, this is a company-sponsored product offered to your employees. They can use this on themselves, and they can also use it on their family members. So we need to define what a family member is. And friendly reminder, these are the definitions that the state has set. So you'll see those first 4 bullets are pretty black and white with what we would all expect a family member to be defined as. And then we get to the bottom right bullet that reads, any other individual with whom there is a significant personal bond. Very gray, very hard to put significant personal bond into a box. I see this coming down to a lot of, you have to take my word for it from the employee's perspective. But I did ask the state's actuaries why we were keeping things so gray. And in a couple slides, I will highlight what I think their perspective is on that. But this is the eligibility of this product and who it can be used on and who you'll have to cover. The product in and of itself is comprised of 3 different types of leaves. So FAMLI is made up of medical leave, family leave, and safe leave. The definitions are laid out, but very quickly I will summarize that medical leave will cover all of your injuries and illnesses as an employee. Family leave will be there for any child bonding, so maternity leave and paternity leave will be covered. This product will be utilized to take care of a family caregiver, like a sick mother, father, grandmother, grandfather. It'll also cover your family leave for any family members being called to active military service. All 3 very different reasons to use this product, but all 3 will be covered through the family product. And unique to Colorado is safe leave. This will cover all your employees and their family members for any domestic violence, stalking, sexual assault, or sexual abuse. So what this tells us is that no one was compliant with this product before January 1st of 2023. No one had policies in force to check all 3 of these boxes. The state has built this product and customized it on their own. So we're all in the same position that we all have to offer this, and we're all offering a new benefit. The last note on this slide is in blue font at the bottom, and that's going to read job protection will apply if the employee has been at their current job for at least 6 months. If applicable, FMLA will run concurrently. There are certain situations specific to safe leave where FMLA will not run concurrently with family, but for the most part, if you are keeping FMLA in mind, both of them will have the same start date the vast majority of the time. But what the job protection means is that if you hire a new employee and they have satisfied that $2,500 threshold, you have to cover them day one. But if they file a claim before they've hit 6 months of tenure, you don't have to have their job protected. So that would follow the same claim life through the state, through the insurance carrier, but you no longer have to keep them on your payroll. After 6 months has been checked, they have to have their job or a job that they're reasonably trained and qualified to perform back available for them when they return. The next slide you'll see is plan designs. Now, I normally would read these benefit calculations because if any of you are familiar with the disability product, you usually can read them fairly simply. It's 1% of pre-disability income up to 1 maximum. I'm sure you're reading this already and not hardly following because that's not at all the way the state has designed this product. There's a couple different percentages at play. There's the state's average weekly wage that will be determining, and then there's a weekly maximum of $1,100 also tied to the state's average weekly wage. My recommendation would always be to refer to the state's website. They do have a benefit calculator under the individuals tab that you can use to input an hourly rate or an annualized figure, and it'll actually calculate your estimated weekly benefit for you. And I recommend that because the state's average weekly wage is subject to change. So even if you did learn this formula in its entirety, the way you know it today might not necessarily be accurate 6 months or a year from now. So the state's calculator will automatically update. So to trust that you're getting the most accurate information, please use their tools that they're giving to us. Elimination period is insurance jargon for waiting period. So how long does an employee need to wait before they're eligible to receive payment? And it's a very strong benefit at 0 days. I think the whole concept behind Prop 118 Colorado FAMLI was to introduce a more employee benefit friendly landscape. And that's certainly the case here because most insurance carriers aren't even able to offer a 0-day short-term disability elimination period. It's always important to note the best practice would be to file your claim as far out in advance to make sure it's approvable and that the carrier or the state has all the information they need to make a determination. Just because it's 0-day elimination period doesn't mean you're going to be paid in 0 days. And then finally, to bring it full circle on the max duration there, you're going to read that it's a 12-week benefit in a 12-month period. And what that means is that 12 weeks can be used as incrementally as your employees would like. So whether it's 1 day right now, 2 weeks later on, and then the remaining portion of their benefit 6 months from now, or even 12 weeks all at once. This will be used at the employee's discretion and no one can tell them how to use their product. The good news is, in a check and balance sort of way, 12-month period will prohibit employees from using 12 weeks to end a year and then 12 weeks to begin the next for 24 concurrent weeks off. And I say that because most dental policies, most medical policies are set up on annual year basis, where you can almost double dip as the year ends and then get a restart on your max January 1st when it resets. So what 12-month period means in an example is that from the date that the first claim has been filed for that employee, a 365-day timer has begun. So hypothetically, March 1st, 2024 is when an employee files this claim. Maybe they only decide to use 2 weeks of this product. They won't get a fresh 12 weeks until March 1st, 2025. They will, however, have the remaining 10 weeks to use all the way up until that March 1st, 2025 date. Again, 12 weeks in a 12-month period. Some important facts to keep in mind with this, not specific to this slide, is that weekly maximum of $1,100 is going to cover everyone at the full designed benefit up to $85,000. If you make more than $85,000, you're going to cap out the $1,100 figure. And it's also important to remember that this is designed similarly to workers' compensation. And what I mean by that is lower income employees will get a higher percentage replacement of their income than what higher income employees will. This is one of the things to keep in mind with the conjunction of a short-term disability policy alongside this Colorado paid family medical leave. And then finally, to bring it full circle, I did mention that the state has maybe purposefully left the definition of family member so broad. And my opinion of why the state has set that up is everyone's going to get 12 weeks. And if you want to use that on your cousin because you're closer to your cousin than anyone else, by all means do it. But after you've exhausted your 12 weeks, it won't be there for your newborn child. And it won't be there if you ever were to get hurt or have any illnesses. So it's a use it wisely sort of mentality there. This is the cost for any employer that has 10 or more employees. I will reference this often, mostly because the state has block priced a rate of 0.9%. So the way to think about that is they've drawn a line that if anyone has 10 employees or more, the total rate is 0.9% of your Colorado payroll, and you as the employer are responsible for at least half of that total cost, or 0.45%. The biggest thing to think about with this is that every company is unique in a million different ways. Whether it's nature of business, industry, demographical makeup of your employees, or more, everyone's paying in to that same cost. And one of the reasons I should say that insurance carriers are entering the market is because we'll underwrite everyone uniquely. So some companies might be more favorable risk to a certain insurance carrier, and maybe that insurance carrier can offer a lesser rate than that 0.9% figure. And in that same concept, vice versa, some companies would be rated poorly with insurance carriers, and the state might be a good option for them. But the point is, you have options at your disposal, and you might not necessarily be getting the best deal until you've vetted out insurance carriers and verified that for yourself. That being said, we will take a slight second to pause. Everything we've just covered is true of the state, the product, the eligibility, the leave types, the cost. We're going to pivot over to the private carrier side. We'll talk a little bit about Principal. We'll also draw some comparisons to the insurance industry and why we're here and why it's something you should consider. This slide is a trophy case for Principal. It's not important to read the details. What's important is that every insurance carrier will have their own trophy case. Every insurance carrier does something better than maybe the one down the street. We all have our niches and we all know where we fit in. So some carriers might be better fits for certain industries, certain sizes, but a lot of insurance carriers are entering the market. The state does have a list of the private carriers that have been listed as approved, meaning that you as the employer are able to move forward with one of our approved solutions. Every carrier will have unique requirements to offer this product. And remember, at its earliest, it's 3 to 4 years old in Massachusetts. So Principal's been an insurance carrier for over 100 years. We've got a lot of data and experience to pull from. We don't necessarily have that for this type of product. So we're all kind of learning the more it goes on. But on this next slide, you'll see what Principal needs. And I do know fairly well what some of the other insurance carriers will be looking for. To my knowledge, everybody is going to be mirroring the state's plan design. The state has said if you want to be an approved carrier, you have to match our product or make enhancements. At this time, Principal is not able to make any enhancements. And maybe I'm wrong here. I don't believe many insurance carriers are. Again, we're learning about this product and we're in some ways going to be keeping an eye on this moving forward to see what we can do in terms of flexibility down the road. But for now, the product you get through the state is the product you get through insurance carriers. We're offering fully insured only. The private carrier sector does provide a self-funded option if that's interesting to your employer. What that means is that you'll have to follow a separate set of requirements, including a surety bond, proving that you're liquid enough to actually self-fund it. And something to consider at least is if you were to think about self-funding, you're budgeting for a product that you really don't have a good grasp on with how much it might cost you. And it's hard in the first couple of years to get a baseline on this product because the first year these things roll out, they're very top of mind, they're talked about from employees, and most people will use them. So it's usually a little bit higher of a utilization year one than what you'll find in years 2 and 3, where it'll dip down and you might have a better concept of, I need to set aside X amount of dollars to make sure I've got this thing covered. Principal needs one or more qualifying insurance products. The vast majority of insurance carriers will also need another line of their ancillary business in order to write this product. Some carriers will be able to write this standalone, others might not. Some might have certain size segments that they require, maybe starting at 50 employees, whereas Principal requires 10. Again, there's no one size fits all. So if you're ever curious about it, reach out to Stacy. She'll make sure she takes care of you and gives you the full scope of information to keep in mind. 100% participation is important to call out. Just because we're all paying into this product, it doesn't matter if you use it or not. So if you're an employee that typically doesn't use benefits, maybe it's something to consider using because you're going to have to pay for it. You're not able to waive this coverage. Everyone has to be covered. And then as I've already mentioned, we'll underwrite every employer uniquely. So we'll capture all the specifics of your company to make sure we're assessing it correctly and giving you a rate that we feel is fair. The next slide here is interesting because this is the key benefits to any private carrier solution. The biggest one is avoid pre-funding with the state. So at the very beginning, when we were talking about the Colorado timeline, I referenced January 1st, 2023, this will be rolling out for everybody to begin contributions. January 2024 is when the benefit's actually eligible to use. So why are we thinking of paying into a product for an entire year of 2023 that we're not able to take advantage of? And the reason is because the state's building up their fund. They don't have reserves set aside for employees to pay their claims come January 1st, 2024. So they're building that up through taxpayer dollars. Every insurance carrier has that pool of money to pay claims. That's why we're an insurance carrier. So we don't need to collect any money on a product that you can't use. Move forward with a private carrier and collect their first dollar of premium come January 1st, 2024. The important deadline to keep in mind with that avoiding pre-funding is October 31st is when that window will close. You can still go forward with a private carrier, but in 2020, on October 31st, 2024, October 31st, 2023, the window will close. And if you've not submitted your application, your first and second quarters of taxes will be kept by the state. If you opt out before then, you will be issued a complete refund of both your employer and employee portions, less a $500 application fee that's payable to the state alongside your application. STD and paid family medical leave, as well as administration, kind of go hand in hand. STD is talking about streamlined claim submission, coordinating payments, but I think the bigger thing to keep in mind with that is the administration is going to be night and day between state and carrier. So administration with the state is going to look vastly different, whether that be through a 1-800 number or a group email address. But you and tens of thousands of employers and millions of employees will all be fighting for the same attention, as opposed to a local insurance carrier giving you a little bit more of a hand-holding feel to make sure your urgent problems are handled diligently, where that might not necessarily be the case with the state. And again, time will tell. But what we do know is that based on other states' examples, The claims processing falls dramatically behind, up to 3 months in certain states. And again, this is a weekly paycheck that's designed to take care of your lower income employees. So to think about a lower income employee filing a claim on maybe a sick mother that's dying very slowly and the child needs to be there to take care of them. If you're going 3 months without any sort of payment, and maybe you really can't go more than 1 or 2 paychecks, it's a little counterintuitive to why this product was invented in the first place. So trust that the insurance carriers that have the infrastructure, process, and consistencies to make these payments accurately and on time to be there in time of need. I wanted to outline a little bit more about STD. Again, we've got some specifics to principal, but the entire industry is going to look at STD differently after PFML has rolled out. Every carrier will be a little bit unique in the way the rate reduction will work, but essentially STD will become less utilized in comparison to FAMLI. FAMLI is going to be the primary payer over everything except for workers' compensation. So because of that, STD is utilized less, and the rates that we need to charge employers to bring in the premium is less. Again, reach out to your specific insurance carrier if you'd want to learn more. But the big things to think about are streamlined claim submissions, coordinated payments to high income earners, and the 3 points of consideration with, should we offer an STD with PFML? Should we just offer PFML? Well, these 3 points are things to take in. Remote employees will not be able to use Colorado PFML. So if you do have remote employees and you were to get rid of a short-term disability product, or you've been on the fence about it, you're leaving your remote employees with no short-term income paycheck protection. That's why an STD would exist for those employees. I've already referenced that if you make $85,000 a year or more, you're going to cap out the $1,100 weekly max. If you were to supplement that $1,100 weekly max with a short-term disability program, we as the insurance carriers would coordinate those payments together and give a higher payout to that employee. So the high income earners might really feel the drop off in income to $1,100, but if we can get them to $2,000, $3,000, $3,500, they'll be that much more taken care of, and they'll be that much more appreciative of you as an employer having their best interest in mind when they least suspect that they'll need to use short-term disability. And then finally is the claim usage. So I made sure to call out how specific the 12 weeks means. So after you've used your 12 weeks, FAMLI is done until your 365-day, 12-month timer has reset. STD will not limit that. It'll continue to pay out every single occurrence that meets your contractual requirements. So if you use your 12 weeks to take care of a newborn child and you've used your PFML benefit, and then you break your leg 3 weeks later, PFML is not going to reset for you, but STD would be there. To wrap up this full discussion, I did put some case studies together to really illustrate what the avoidance of pre-funding will look like. Because at the end of the day, 0.9% is fairly arbitrary. Every payroll will be different. Your Colorado makeup might be different than your competitor down the street. But here's what we can look at. So the case study number 1 was an IT company, 260 employees, rated with principal very favorably. And insurance carriers will view IT companies and engineering companies as white collar and lower risk because they're not putting themselves in jeopardy while they're doing their duties. And studies have shown that their hobbies are less risky as well. You compare maybe an oil miner or a skydiving company, as many of those as there are in Colorado, those are going to be higher risk and might be rated a little bit higher. So this isn't to guarantee any sort of rates. This isn't to show how competitive principal is. This is to illustrate the savings provided in 2023 and the options you have, but you might not even realize it, right under your nose with all of these insurance carriers who are very confident administratively we're going to be there, price-wise we're going to be there, and support, we'll always be there for our broker partners and clients as well. I just want to put a quick disclaimer. The premiums that I ran were pulled from the state's website, and these are estimations at the very most. So please don't hold me to these numbers, but these do capture payroll figures, estimated premiums, and the differences in ratings. Stacy, that's all I had planned for today. We talked about eligibility, leave types, how to use it, when to use it, the options you have at your disposal, and the why behind insurance carriers entering. Thank you again for allowing me to be a part of this. I really appreciate it.
Thank you, AJ. Really appreciate your being here. I don't think we have any questions, but if anybody in the audience does have questions, they can contact me because I actually have to be the one that sends anything to AJ. So, but thank you. A very, very, really good discussion on FAMLI, and appreciate your time today.
Thank you again.
Thanks, AJ. And now we're going to go into my presentation on ACA small group health insurance. So I'm going to just start real quick and and discuss what's going on with the marketplace. We've had a couple of companies leave the market in this last year. Bright Health and Humana left the both the fully insured and level group market, and so did Friday Health Plans. And they just got shut down by the Department of Insurance this summer for not having enough money to pay the claims. Having less insurance companies means there's going to be less competition and higher premiums in the ACA marketplace. We're looking at 5.9 to 14.99% in the fully insured individual, which is on top, and the small group market on the bottom. And just to be honest, I'm seeing even higher increases on some plan designs. That we will have those rate increases solidified by the middle of October is what we've been told, but this is what was submitted this summer. So this is not going to be your final, but that was what was submitted. So what do we have in the way of ACA small group for this fall? We have the Colorado Doctors Plan Select Network, Navigate Network, Choice PPO, and the Choice EPO through United Healthcare. If you're on one of the HMOs, you do require a primary care physician with both Colorado Doctors Plan Select and Navigate. There is a lot of moving parts right now with hospital networks. Advent Health and Common Spirit used to be part of Centura, and they just split up, but they are on Doctors Plan. UC Health and SCL are heavy for the Select Network. Navigate is a larger HMO network that covers much of the doctors that you'll see on the Select and the Colorado Doctors Plan Network. And if you want to see any doctor you want to go to in the country, you want to be on a PPO or EPO with United Healthcare. Anthem has opposite networks to United in the HMO realm. They have their Pathway Essentials and their Pathway statewide EPO. The Essentials is a front range network. It does not include UC Health, Centura, or SCL. The Pathway statewide EPO does not include any of those hospitals either, but it has most of the hospitals in the state in the mountain and rural areas. Anthem's PPO is nationwide, in-network and out-of-network coverage with a blue card that ensures members can access coverage while traveling out of state. Kaiser is a front range product that has select counties in the front range, and it requires a referral. They have a much smaller hospital network and probably about half the size as what you'd see with Colorado Doctors Plan or Pathway Essentials. And they do have a PPO option to help with out-of-town dependents. Why are small businesses now trying to lock in lower premiums for 2024? Well, one, if you can avoid the mess in November and December for January plan installs, the further we go into the fall, the longer the queues at all the insurance companies. 2024 premiums are going to be higher than 2023. If you're thinking of waiting to start your plan, you're going to want to lock in for November or December 1st so you can save yourself those premium increases that I just showed you. Also, 2024, you're going to see health plans that have higher out-of-pocket max and higher deductibles in the ACA market than the previous year. If you'll recall, when we started the ACA, we dumped everybody into the fully insured market. So everybody with health conditions, everybody that didn't have health conditions, anybody who want to participate. And you have a group that's aged, more health conditions in there. They have no way to underwrite. So all we have is higher deductibles and higher out-of-pockets every year, along with higher costs in the ACA market. So with that explanation of what's going on with the ACA market, let's talk about the alternatives to the ACA market. So the first thing I'm going to chat about is the ICRA. This is a way of just sending your staff to the individual market with a stipend. It can be a good choice for microbusiness, groups with young employees, and staff who need access to different networks. But mostly there's a lot of cons. There's problems with sending your staff because they leave the employees with higher monthly premiums and HMO-only plans with skinny networks, higher out-of-pocket max than you'd find in the small group market. And then how does the owner even know that the employee is using the stipend to purchase individual health insurance? What are the implications if you're audited and don't have proof that they kept the policy in force? Are you going to get proof monthly? The individual plans could be discriminatory toward workers in their 50s and 60s who tend to have higher costs in the individual market. Participation in an ICRA actually precludes the employee from a subsidy from Connect for Health Colorado. You can't double dip tax-wise on the savings. It also can make it difficult to hire both local and remote workers. HMO market in other state might be high cost and even a skinnier network. High-paid industries like IT, healthcare, consulting, they expect a nationwide PPO. And when you're putting people in the individual market, it doesn't give them the look and feel of a true, well-rounded benefits package. Everyone has their own health insurance. So you're going to have a secondary benefits package with dental and vision and life insurance. The second item I'm going to chat with you real quick about is bundled plans. Bundled plans can be a great alternative for startups and small businesses that have to get benefits up and running quickly. These programs bundle large group health insurance, dental, vision, disability, and other benefits along with HR and payroll for small business. Sometimes select bundlers can offer a better value to employers currently enrolled in the ACA fully insured market or just starting out. But you have to understand the products, what companies charge, and their admin fees. Your small group has access to large group health plans with these products. Typically, they're on an Aetna, UHC, Blue Cross Blue Shield, or Cigna PPO. Occasionally, you'll find a Kaiser Network HMO in some markets included with the PPO. The right bundled plan will have lower fees, a national PPO, and help a startup get going with a terrific package. The problems that we have with some of these bundled plans, many national companies charge very high fees and fees on top of fees. And just quickly, I'll tell you, I have a group that we took off of a national group. And that particular national product, they had $300 a month in fees on top of the PPO or the medical, the dental, the vision, all the other stuff. When we look at these for clients and try to get them the best deal, our goal is to get them under $100 in monthly fees that handle the HR, the admin fees. Medically, these plans are all medically underwritten, best for healthy groups. Some bundled companies have health insurance that can have higher costs than the ACA small group market. If you've got some severe conditions in the group, you may have to stay in the ACA small group market. The bundler or administrator chooses the benefits package and the network, and you're basically stuck with what they give you to participate. And you really need a broker to evaluate these products. So the last item I'm going to go through and focus on is level funding. This is my specialty. It's a great option for businesses with 5 or more healthy employees enrolling. It's much lower cost than ACA plans. Savings are 15 to 40% over ACA fully insured insurance. Nationwide PPO networks, including Cigna, Aetna, Anthem, and United Healthcare. Plans that are better than the ACA. You'll have lower out-of-pockets for the employees, lower deductibles, and custom designs. Some plans even have ER copays. There's cash back after the plan year if the group has a good plan year. And I have companies that get checks anywhere from $5,000 to $12,000, depending on the size of the group. Some larger groups are going to get bigger checks. The only problem you have with level funding is if you've got groups that have health conditions with, several people that have diabetes, rheumatoid arthritis, going through cancer treatment, they may not qualify right now for level funding. So level funded plans have premiums that are locked in for 12 months. They have cash back after the plan year, monthly premiums and billing that look like a fully insured plan with access to claims, and lower premiums with the possibility of some cash back. Typically, these plans have individual medical questionnaires for the smallest groups. These are typically done on a benefits platform if you've got the right broker. We use Employee Navigator for benefit admin, and employees just fill out the online app. And we have in the background checked off a multitude of apps so it can go into the carriers once we get the one questionnaire completed by the employee. There's a group risk questionnaire that the group administrator answers. If you have previous plan experience for another level funded plan, they look at that. And then everybody's using Curve or GRX on groups of 10 or more, and sometimes on 5+ even with the apps. They basically score the group based on certain characteristics in the group, prescription drug histories. You have a lot of people in there that have DUIs, things like that. Those are the things they look for. Proprietary tools are being used, like hair, but that's what's used to determine the health of the group so that they can come up with the rates. So when we put these plans in place, you're looking at better plan design that has a lower deductible, a lower out-of-pocket, usually significantly lower than the ACA market, lower premium taxes because you're not paying the taxes that are built into the ACA plans. So they have complete rate transparency in the background showing how everything is calculated. Predictable monthly costs, no state mandated benefits, although level funded plans have to comply with the ACA for rules on mental health and wellness. You'll get claims information. And one of the things that I like about level funding is I can go out and negotiate the renewal. When's the last time that you heard a broker tell you that they could reduce your medical renewal cost on an ACA plan? Like never. But I'm going, and if I've got a level funded renewal, I'm going to bat for my client and trying to shave off as much as I can for the renewal rate. There's surplus plus potential for your claims funding. Are you currently getting a check back from your insurance company? Most people in the ACA, they're not seeing that. And it's a great long-term strategy to control your costs. This is an example of a front range subcontractor that I have in the Springs. They have a $2,000 deductible plan, $7,150 out-of-pocket max, level funded plan. It's a PPO with an Aetna network and a $500 ER copay. And that ER copay means that that employee will not have to pay more than $500 out of their pocket unless they have stuff done in the hospital, like a CT scan or something. So that is a big value to some employees, especially blue and gray collar workers that are paycheck to paycheck. So you can see, I've had this client now for 6 years, and you can see where their premiums have gone and how we've kept those premiums really tight with the renewals. We had some stuff happen last year, and then you can see if we took a United Healthcare $3,000 deductible plan with an $8,500 out-of-pocket max ACA with no ER copay because there's none on the ACA market, you're looking at a plan that is almost twice as much in the ACA market. We're in year 6 and we're still saving almost 50% on the health plan for the employee. And that's all I have to chat about. I did want to let everybody know, if you are interested in more information, my email is on here, Stacy@Denver Tech Insurance. I will provide a file that I will send to you. It'll be a zip file with a bunch of information that'll be helpful for open enrollment, a 2024 open enrollment checklist. We also provide our clients with Mineral HR, which is a $5,000 package if you were to purchase it separately. But document compliance is what it's all about right now, because if you get fined by the IRS, you could end up with thousands of dollars in taxes that you'd have to pay. So we make sure our clients have document compliance on everything. And then the other thing that we want you to be aware of is there is a hard stop on FAMLI. FAMLI is coming up for anybody that wants quoting, that was interested after hearing AJ's presentation. That particular product, that PFMLI, most of carriers, I have to get the stuff in the next week or two, because you have to have time to get your paperwork into the state. The state is going to have a long queue, and we do not want anybody waiting until the 31st to submit their paperwork. That you'll get a certificate from the PFMLI carrier. You'll fill out an application and attach that certificate and your fee and upload it to the state. And you need to have, you want to be getting that uploaded by the 20th of October. So if anybody's interested in looking at PFMLI, I've got clients that I have one that's saving $20,000. And I've got, most of my groups are saving $5,000 to $10,000, depending on the size of the group and their industry. The rates that I've been seeing have ranged on the white collar from 0.22 to 0.67, and then MetLife is one of our carriers that we work with, and they have a shelf rate of 0.78. So that's not only lower than the family rate of 0.9, but in addition, you have the access of getting an insurance carrier that'll get your benefits taken care of for you right away.
Hi. I actually do have a question.
Sure.
AJ mentioned in his beginning part that remote workers are not eligible for the FAMLI product. Does that include remote workers based in Colorado or just outside of Colorado?
No, just people outside of Colorado. Everybody in Colorado has to be covered. Yeah, but I've got an IT company right now with 25 employees, and only 8 of them are in Colorado, so they're going to have to stick with family. They can't get a PFMLI plan.
Gotcha.
Yeah, and they have short-term disability, so they're okay.
Yeah. Okay. Thank you.